What are special employee provisions negotiated as part of the term sheet negotiation process between company and investors? Well, generally, this is the establishment of contractual rights or a contract between the company and existing employees of the company, particularly high-level management or dedicated innovators within the company. Now, why is this part of term sheet negotiation? Well, generally, investors want to make certain that the current management team or key individuals in the organization remain in the organization for some period into the future. This is contingent upon them investing in the company, so the investors do not want to put their money in the company without making certain that these key employees are locked up and are going to continue to take part in the management or operations of the company, so they want to incentivize them accordingly. So what happens? Well, as part of the negotiation process, investors demand that the company enter into employment agreements with key individuals that state that the key individuals will receive an ownership interest in the company or additional ownership interest in the company, either in the form of equity or stock options that will vest over a period of time following the financing by the investors. This basically keeps the management or the recipient, the employee, incentivized throughout this period to continue to function at a high level within the company and to be continually motivated by the company's success. Because if the key individual discontinues work or stops performing at a high level, they can be removed or fired, and any equity awarded to them that has not yet vested will be forfeited. So once again, it keeps management incentivized to continue working diligently for the success of the business. The preferred shareholders will also want to make certain that any equity that's awarded as part of this arrangement is already dedicated, or there's an option pool dedicated for this purpose, and that it does not affect the amount of interest purchased by the preferred shareholder. That is, it's not later issued and thus diluting the ownership of the preferred shareholder. This pool needs to be set aside prior to the financing round so that the preferred shareholder receives their interest on a already fully diluted basis and it doesn't affect them negatively. So this is why special employee provisions are negotiated as part of term sheet negotiation.